Brothers, check your brokerage accounts today and ask yourself if your hands are shaking, because the biggest wealth redistribution game in human history is unfolding right under our noses. Everyone is screaming on social media that the $5,000 gold dream is completely dead, all because Russia just dumped $43 billion worth of gold, dropping its holdings to the lowest level since the 2022 invasion of Ukraine. But let me tell you the absolute truth, the data never lies. And if you are panicking right now, you are falling straight into the trap of big Wall Street institutions. Let us be completely honest here. That seemingly terrifying 28 tons of gold sold by Russia is just a tiny 1.2% drop of its total reserves. It is barely enough to scratch the surface. The real horror story isn't happening in Moscow. It is exploding right in Washington, D.C., where a massive $39 trillion national debt is burning a giant hole through the global financial system. America's interest expense alone has officially bypassed its entire military budget. And Donald Trump just broke a 40-year presidential precedent by hosting a lavish White House inauguration for the new Fed chairman Kevin Warsh. Why would a president roll out such a ridiculous red carpet for a central banker? Simple. He is desperately cornering the Fed to slash interest rates to keep the American empire from defaulting on its debt. So where does that leave our money, and what is the play for gold right now? Let me give you the hard, unfiltered conclusion straight away. Russia's minor gold liquidation has zero impact on long-term bullion value. The only variable that actually matters to your portfolio is the Federal Reserve, because we are stuck in a weird transitional bottleneck where physical gold is temporarily flowing out while global monetary policy is preparing for a massive, violent U-turn. The gold price is currently jammed right in the middle. But if you look closely at the trading charts, big institutional buyers are quietly accumulating blocks at the bottom. Let us peel back the layers of this giant financial onion one by one, so you don't get chopped up by market volatility. Layer number one, how much gold did Russia actually sell? And why the hell did they do it according to the latest Bloomberg data up to May 1st? Russian gold holdings dropped by about 900,000 ounces, bringing their total storage down to 73.9 million ounces, based on the average spot price of gold before April, which hovered around $4,800 per ounce. This reduction equals roughly $4.3 billion. That sounds like an insane amount of money to an average retail investor. But you need to understand the absolute scale of global central banking. Russia is still sitting comfortably on 2,305 tons of physical gold, ranking 6th largest in the entire world, right behind the United States with 8,000 tons. Germany with 3,000 tons, and China, Italy, and France all holding around 2,000 tons each. That $4.3 billion sale is just a tiny fraction of their ledger, and it was executed through slow, linear liquidations over months. Not a sudden panic dump on the open market. Why are they selling? It is not because they hate gold or think the price is going to zero. It is because running a massive 3-year war is incredibly expensive. Western sanctions have completely choked Russia's traditional oil and natural gas export revenues, yet their military spending is increasing every single day. Bloomberg reports show that the Russian Ministry of Finance has been constantly draining gold and foreign currencies out of its national wealth fund just to plug the massive budget deficits caused by falling energy profits. The central bank's selling is simply a technical mirror mechanism to help the government cash out its assets and stabilize the volatile Russian ruble. It is not that the central bank wants to sell, it is that the Ministry of Finance is desperately screaming for cash. And the central bank is forced to liquidate the family's silver. There is an extremely critical timeline you must realize here. Russia's central bank completely stopped buying gold from domestic miners back in early 2020, but the invasion of Ukraine did not start until February 2022. That means Vladimir Putin was hoarding billions in cash and gold 2 full years before the first tank crossed the border, buying up almost 100% of Russia's internal mining output. This war was never a spontaneous decision. It was planned meticulously on a balance sheet years in advance. So when the war machine started eating up billions a month, the central bank had to halt accumulation and eventually start selling to stop the ruble from falling off a cliff. Now let us move to layer number 2. Is Russia an isolated case, or is this the start of a massive global panic trend where all central banks dump gold? Let me put it bluntly. Absolutely not. Because we have seen this exact financial playbook play out multiple times with other struggling economies. Look at Turkey. In 2024, the Central Bank of Turkey went on a massive gold-selling spree, dumping over 100 tons of gold in the first half of the year alone. The reason was identical to Russia. The Turkish lira was hyperinflating, their foreign exchange reserves were completely empty, and they had to sell gold to buy US dollars to keep their economy alive. The media screamed that the gold market was doomed back then too, but what actually happened, gold prices completely ignored Turkey and rocketed to all-time highs. Why? Because the smart money knows that defensive selling out of sheer economic desperation is completely different from a strategic structural shift. Away from gold, the exact same thing happened with Poland. The National Bank of Poland trimmed its gold holdings in 2024 because of rising fiscal pressures. as they had to rapidly scale up military equipment purchases to counter regional security threats near their borders. But Poland's sales were tiny drops in the bucket compared to global volume, leaving the broader international market completely unbothered. Then there is the big player that everyone on social media completely misinterprets: China. According to official data from the World Gold Council, the People's Bank of China saw its official gold reserves hit a high of 2264 tons in November 2024, after which the monthly reporting numbers flattened out to zero changes. Retail traders panicked, thinking China was completely done buying gold and that the bull market was over. But if you understand central bank psychology, China didn't T-stop because they lost faith. They simply paused their buying program because the price shot up too fast. A massive 2264-ton baseline doesn't T-move easily, and a temporary pause under high prices is just standard institutional treasury management. When you stack all these historical cases together, the underlying rule is crystal clear. Every single central bank that sold gold did so because of severe fiscal deficits, war expenses, or extreme currency devaluations. Not a single central bank governor woke up and sold gold because they thought it was a bad asset. This is institutional survival, not a retail trader panic selling at the bottom. If you look at the aggregate global data, central banks are actually buying gold at an unprecedented historic rate. According to official data for the first quarter of 2025, global central banks recorded net gold purchases of 244 tons for the full year of 2024. Total central bank gold buying reached an astonishing 1,045 tons, marking the third consecutive year where net global purchases broke past the 1,000-ton threshold. This is the second highest annual buying volume in recorded human history. So while distressed nations like Russia, Turkey, and Poland are forced to liquidate portions of their holdings for immediate cash, heavyweights like China, India, and the ultra-wealthy Middle Eastern states are aggressively vacuuming up every single ounce available. Central banks as a collective global unit remain massive net buyers. Look at India. In 2024 alone, the Reserve Bank of India added over 70 tons of gold to its vaults, firmly holding its position as the second largest sovereign buyer globally. Over in the Middle East, oil giants like Saudi Arabia, the UAE, and Qatar are continuously allocating billions of surplus petrodollars directly into physical gold. Their strategic objective is obvious: accelerating de-dollarization and replacing paper fiat liabilities with unprintable sovereign wealth assets. So on one side of the scale, you have a few broke nations selling gold under extreme economic pressure, while on the other side you have a massive coalition of wealthy nations aggressively hoarding bullion to protect against long-term inflation. This tells us that the global macro perspective on gold has not changed one bit. The only thing shifting is individual national budgets. Now let us move to layer number 3. Why are we seeing these dramatic moves right now at this exact moment in time? Because while Russia is selling its gold assets for survival, an unprecedented financial drama is playing out across the Atlantic Ocean inside Washington, D.C. Donald Trump recently held a massive, high-profile inauguration ceremony right inside the White House for the newly appointed Federal Reserve Chairman Kevin Warsh. Let me explain to you exactly how bizarre and alarming this event truly is. Ever since 2018, the swearing-in ceremony for a Federal Reserve chairman has always been hosted quietly inside the Federal Reserve headquarters, completely independent of the executive branch, with the president not even showing up to maintain the appearance of institutional separation. The last time an American president actively hosted a Fed chairman's inauguration inside the White House was all the way back in 1987, when Ronald Reagan installed Alan Greenspan almost 40 years ago. The only other instance of a president trying to pull off this level of public theater was in 2006, when George W. Bush celebrated Ben Bernanke, but even that ceremony didn't happen inside the actual White House compound. Trump's decision to break a 4-decade protocol and grant Kevin Warsh this level of extreme presidential spotlight carries a very loud, dangerous message. He is publicly telling the world that the Federal Reserve belongs to the White House. Now, and he needs Warsh to slash interest rates immediately, because the U.S. financial structure is on the verge of a massive breakdown. America's total national debt has blown past $39 trillion, and the annualized interest payments on that debt have become so massive that they officially cost more than the entire U.S. national defense budget. Trump wants to push massive corporate tax cuts while simultaneously running aggressive fiscal expansion projects. Where is that infinite money going to come from? The only way to fund this entire plan without causing immediate bankruptcy is to force the Federal Reserve to aggressively lower interest rates, thereby cutting the government's borrowing costs. This public pressure on Kevin Warsh is not some random political theater. It is a life-or-death necessity for the U.S. Treasury. Now, you might argue that Kevin Warsh is historically known as a monetary hawk, meaning he prefers high interest rates to fight inflation. And he won. Just bow down to Trump's demands. That is technically true on paper. But the historical relationship between an American president and a Federal Reserve chairman is never set in stone. It evolves constantly under heavy political warfare, A Fed chairman can either hold the line as an independent protector of the currency or completely collapse into a political puppet for the White House. Everything depends on whether the individual chairman can survive the immense pressure of the Oval Office. Let us look closely at the history of the modern Federal Reserve, because the patterns of the past 8 Fed chairmen tell us exactly what kind of storm Kevin Warsh is walking into. First, look at William McChesney Martin, the longest-serving chairman in history who managed the central bank for nearly 20 years across 4 different presidencies. Martin famously declared that the Fed was not an agent of the Treasury, moving the core power of the central bank away from Wall Street in New York directly to Washington, building an impenetrable wall of institutional independence. Second, look at Arthur Burns during the Richard Nixon administration, who stands as the absolute worst puppet in central banking history. Burns completely surrendered to Nixon's political demands, keeping interest rates dangerously low to artificially boost the economy before an election, which completely destroyed the Fed's independence and directly triggered the horrific stagflation crises of the 1970s. Third, look at G. William Miller during the Jimmy Carter era. Carter didn't even apply heavy political pressure on him, but Miller was simply incompetent, consistently misjudging rising inflation and failing to tighten policy until the economy spiraled completely out of control. Fourth, look at Paul Volcker, the ultimate gold standard of central bank independence. Volcker ruthlessly jacked up interest rates to a staggering 20% to kill inflation, fully knowing it would trigger a painful economic recession and massive unemployment across America. When President Ronald Reagan's administration repeatedly ordered him to cut rates, Volcker completely ignored the White House, prioritizing the long-term health of the dollar over political popularity. Fifth, look at Alan Greenspan, a master political operator who kept the Fed independent but actively used his influence to support executive tax cuts, becoming the first chairman to explicitly bridge the gap between monetary policy and federal fiscal spending. Sixth, look at Ben Bernanke, who faced the devastating 2008 global financial crisis. Despite working in lockstep with the White House to execute massive emergency bailouts, Bernanke fiercely defended the Fed's boundaries during congressional hearings, reminding politicians that monetary decisions must remain free from short-term political interference. Seventh, look at Janet Yellen, who maintained a highly disciplined, low-profile institutional approach, keeping policy completely clear of political theater during both the Obama and early Trump administrations. And eighth, look at Jerome Powell, who faced what was arguably the most hostile presidential pressure campaign in modern history. Throughout Donald Trump's first term, Joe Biden's presidency, and moving into Trump's second term, Powell's entire career was defined by his constant battle to protect the Fed from public attacks. Ben Bernanke famously noted that Powell learned early on how to maintain total policy independence, despite dealing with constant aggressive tirades from Trump on social media. Reuters summarized Powell's core legacy as a relentless defense of the Federal Reserve's institutional boundaries, even when facing constant threats of being fired or hit with political lawsuits. When you review this historical timeline, out of the last 8 Fed chairmen, 6 successfully defended their independence while only 2 completely failed, giving independent chairmen a 75% historical survival rate. The chairmen who survived all shared 2 distinct traits: exceptional macroeconomic competence and an incredible tolerance for political stress. If a chairman lacks either of those qualities, they get crushed by the political machine. Kevin Warsh is widely recognized for his deep academic pedigree and solid institutional experience, but he is now stepping into the arena with the most aggressive, unpredictable president in modern U.S. history. Powell barely survived 4 years of political pressure, and Warsh was immediately marched into the White House for his swearing in on day 1, which acts as a clear psychological warning from the executive branch. The multi-trillion-dollar question is whether Warsh can maintain his hawkish independence. If he holds the line and refuses to cut interest rates prematurely, the U.S. dollar will remain strong, putting heavy short-term downward pressure on gold prices. But if he buckles under Trump's immense pressure and floods the system with cheap money, the dollar will collapse and gold prices will skyrocket completely out of control. The final outcome does not depend on Warsh's personal ideology. It depends entirely on how much longer America's $39 trillion debt mountain can survive before collapsing under its own weight. Now let us bring layer number 4 into focus and connect all these seemingly random clues together. Russia's $4.3 billion gold liquidation is not going to cause a domino effect of central banks selling across the world, because institutional players can easily see that this is a localized survival move by a war-torn nation, not a strategic shift away from hard assets. But what you must pay attention to is the exact timing of this sale, which is happening precisely as Trump maximizes his pressure on the Federal Reserve to force interest rates down. Think about the sheer scale of this setup. One of the world's largest sovereign gold holders is forced to sell physical bullion for paper cash. While the leader of the world's largest economy is actively breaking protocols to force his central bank to print more money, with physical liquidations occurring on one side and a massive monetary policy shift building on the other, gold prices are trapped inside a rigid trading bottleneck. If you look closely at recent trading sessions, gold is behaving exactly as an experienced investor would expect, grinding through a tight horizontal consolidation pattern on the surface. The immediate trend looks like a minor downward slide, but notice how the price completely refuses to break lower. Look at the massive trading volume quietly accumulating right at the support floor. The standard volume distribution profile has officially shifted down to the lower bounds of the current range, which clearly indicates that massive institutional buyers are stepping in behind the scenes to absorb every single ounce of retail panic selling. This heavy accumulation pattern at the bottom is a very aggressive classic bullish indicator. And while the price hasn't completely broken out of its cage yet, the structural direction is tilting heavily toward the upside, barring a sudden black swan macroeconomic event. The probability of a massive upward breakout is significantly higher than a breakdown below support. So let us wrap this all up. Russia dumping $4.3 billion worth of gold is not a warning sign that central banks are abandoning hard assets. It is simply a broke government liquidating its savings to fund a prolonged military conflict. The true story is the incredible timing of this liquidation colliding directly with Trump's unprecedented pressure on Kevin Warsh. While history gives the Fed a 75% chance of retaining its independence, the current $39 trillion debt crisis means Warsh is facing an institutional storm of historic proportions. My professional evaluation of the data shows that heavy institutional buy orders are steadily stacking up at the current price floor, making an upward breakout highly probable over the coming months. But remember, all of this analysis represents my personal professional perspective, and it should never be taken as formal financial advice. The financial markets are incredibly risky, so always make sure to manage your downside risks and place tight stop losses on your trades if you want to protect your savings and see through the constant noise of mainstream financial media. Make sure to hit that like button, subscribe to the channel, and drop your thoughts in the comments below. See you guys in the next breakdown.